Ladies and gentlemen, what you're about to hear isn't another headline. It's a crisis signal from the heart of the financial system. Just moments ago, Comex, the world's most important commodities exchange, stopped silver selling entirely. Not because prices were stabilizing, but because 45 million ounces were claimed in a matter of minutes. When markets behave like this, it's not noise. It's a siren going off. We talk about markets finding prices. What we're witnessing is markets reacting to stress. This is not volatility. This is a system responding to an untenable mismatch between paper claims and physical reality. What we're witnessing right now is not a routine market fluctuation, not a technical glitch, and certainly not some random coincidence that can be brushed off by analysts who are paid to stay calm. This is unprecedented market stress revealing itself in real time. When an exchange like Comex effectively freezes silver selling after tens of millions of ounces, are suddenly claimed, that is not a sign of strength or stability. That is a sign that the system is straining under a weight it was never designed to carry. For years, the silver market has been dominated by paper promises, rather than physical reality. Contracts are traded back and forth at volumes that dwarf the actual amount of metal available for delivery. Under normal conditions, this illusion works because most participants never ask for the real thing. They settle in cash, roll contracts forward, or simply trade for speculation. But the moment confidence shifts, when too many players decide they want physical silver instead of paper exposure, the entire structure is tested, and right now, that structure is cracking. Think about what it means when 45 million ounces are claimed in such a short period of time. That is not casual interest. That is not retail speculation driven by headlines. That is institutional scale demand, asserting itself in a market that is already tight. When supply is ample, markets don't freeze, they adjust. Prices move, sellers step in, and equilibrium is restored. A freeze happens when there aren't enough sellers willing or able to meet demand at any price that keeps the system functioning smoothly. This is where the stress becomes obvious. The silver market has been living off accumulated credibility, not abundant in inventory stocks have been drawn down year after year, while industrial demand continues to rise. Investment demand resurfaces during periods of monetary uncertainty, and mining supply struggles to keep pace. Yet prices suppressed by paper trading and leverage have not reflected this reality. That mismatch can persist only as long as trust holds. Once trust begins to erode, the reaction is sudden and violent. A market freeze is not about protecting investors, it's about protecting the system itself. When selling is halted, it's an admission that allowing free price discovery could expose weaknesses that have been carefully managed, delayed, or ignored. It suggests that the exchange is more concerned with maintaining order than allowing the market to speak honestly. And when markets are prevented from speaking, it's usually because the truth would be uncomfortable. What makes this moment particularly significant is the broader economic backdrop. We are living in an era defined by excessive debt, chronic deficits, and monetary policy that relies on constant intervention. Confidence in currencies is already fragile, propped up by narratives rather than fundamentals. In that environment, real assets like silver don't just serve industrial purposes, as they act as barometers of trust. When demand for physical metal surges, it often reflects deeper concerns about the value of money itself. This kind of stress doesn't emerge overnight. It builds quietly while official commentary insists everything is under control. But markets have a way of revealing what policymakers and institutions prefer to hide. A freeze is a flashing warning light. It tells you that liquidity is not what it appears to be, that availability is more limited than advertised, and that the system's margin for error is shrinking. Some will argue this is temporary, that normal trading will resume, and everything will return to business as usual. That argument assumes the underlying issues have been resolved. They haven't. Paper claims still outweigh physical supply. Inventories are still tight. Demand pressures haven't disappeared, and confidence, once shaken, is not easily restored. Even if selling resumes, the memory of the stress remains, and market participants adjust their behavior accordingly. The real danger lies not in a single freeze, but in what it represents. When markets begin to show signs of strain, they rarely do so in isolation stress in one corner, often preceding stress elsewhere. Silver may be a relatively small market, but it is deeply connected to broader financial and monetary dynamics. If this market cannot function smoothly under pressure, it raises serious questions about how other much larger markets will behave. When faced with similar challenges, ultimately, unprecedented market stress forces a reckoning. It challenges assumptions, exposes vulnerabilities, and reminds everyone that financial systems are only as strong as the confidence that supports them. When that confidence wavers, even briefly, the response can be dramatic. What we are seeing now is not just about silver. It is about the limits of paper markets. the consequences of prolonged distortion, and the inevitable moment when reality asserts itself. This is how cracks form quietly at first, then all at once. And once they appear, ignoring them doesn't make them disappear. It only ensures that when the next shock arrives, the system will be even less prepared to handle it. The silver market today is a textbook example of what happens when long-term structural imbalances are ignored in favor of short-term convenience. Supply and demand are no longer meeting naturally. They are being forced into alignment by financial engineering, paper contracts, and the assumption that physical shortages can always be deferred. For years, this imbalance has been building beneath the surface, largely unnoticed by those focused only on price action rather than availability. Now, the consequences are becoming harder to dismiss. Silver is not just a monetary metal, it is an industrial necessity. It is consumed in electronics, solar panels, medical equipment, and countless other applications that underpin modern life. Unlike gold, much of the silver used in industry is not economically recoverable once consumed. That means demand doesn't simply pause during economic slowdowns. It shifts and reappears, often stronger as new technologies expand. Meanwhile, supply growth has remained constrained, not because silver isn't valuable, but because it is primarily mined as a byproduct of other metals. This structural reality limits how quickly production can respond to rising demand. Mining companies cannot simply flip a switch and produce more silver because prices rise. New projects take years to develop, require significant capital, and depend on favorable regulatory environments that are increasingly rare. Even existing mines face declining ore grades, rising energy costs, and mounting political risk. The result is a supply pipeline that is rigid and slow, incapable of meeting sudden increases in physical demand without stress. At the same time, inventories that once acted as buffers have been steadily depleted. Exchange-registered stocks and accessible above-ground supply have been drawn down to levels that leave little room for error. These inventories were never meant to support an endlessly expanding paper market layered on top of them. Yet, that is exactly what has happened. Claims on silver have multiplied far beyond the metal available to satisfy them, creating a system that depends on most participants never asking for delivery. This is where the imbalance becomes structural rather than cyclical. It is not about a temporary shortage caused by a strike or weather event. It is about a market design that assumes scarcity can be managed indefinitely through confidence and settlement mechanisms, as long as demand remains passive and speculative illusion holds. But when industrial users, investors, or institutions decide they want physical silver, the gap between promises and reality becomes impossible to ignore. What makes this imbalance particularly dangerous is that prices have not been allowed to perform their natural function. In a free market, rising scarcity leads to higher prices, which in turn incentivize increased production, reduced consumption, and substitution. But when prices are distorted by excessive leverage in paper trading, those signals are muted. Producers don't receive the incentive to expand supply, and consumers don't adjust behavior because the price doesn't reflect true availability over time. This creates a feedback loop. Low prices discourage investment in new supply, which tightens the market further. Tight supply increases the risk of delivery stress, which then requires more intervention to maintain order. Each intervention pushes the imbalance further into the future, making the eventual adjustment more severe. This is not stability. It is deferred volatility. The structural nature of the imbalance also means it cannot be resolved quickly or painlessly, even if prices were allowed to rise sharply. Supply would not immediately respond. Years of underinvestment cannot be reversed overnight. Meanwhile, higher prices would likely attract even more investment demand, particularly in an environment where confidence in currencies and financial assets is already under pressure. That dynamic could exacerbate shortages rather than relieve them. There is also a psychological component that is often overlooked once market participants begin to question whether physical silver will be available when they need it. Behavior changes. Contracts that were once rolled forward are suddenly settled with delivery. Inventory becomes something to secure rather than assume. That shift in mindset can rapidly accelerate demand, overwhelming a system already stretched thin. This is why structural imbalances matter. They don't announce themselves with gradual adjustments. They reveal themselves through stress events, delays, and disruptions. By the time they become visible, the options for a smooth resolution are limited. What remains is a choice between allowing prices to rise to reflect reality or continuing to suppress signals at the cost of market credibility. In the long run, physical markets always win. You cannot consume paper, silver, build technology with contracts, or power industries with promise. Eventually, The market must reconcile what is claimed with what actually exists. The longer that reconciliation is delayed, the more dramatic it becomes when it finally occurs. The silver market is approaching that point, not because of speculation, but because of years of structural imbalance that can no longer be ignored. The disconnect between physical silver and the paper market built around it has become one of the most glaring distortions in modern finance, and yet it continues to be treated as normal. On paper, silver appears abundant, liquid, and endlessly tradable. Contracts change hands at lightning speed. Volumes surge and collapse within minutes, and prices move as if they are responding to real supply and demand. But beneath that surface lies a very different reality, one where actual metal is finite, slow to produce, and increasingly difficult to source in meaningful quantities. The paper market was originally designed to facilitate hedging and price discovery. Producers could lock in prices. Consumers could manage costs, and investors could gain exposure over time. However, this system evolved into something far removed from its original purpose. Paper claims multiplied far beyond the physical metal backing them, turning silver into a financial instrument first and a tangible commodity second. The result is a market where most trading activity has little to do with silver itself and everything to do with leverage, speculation, and short-term positioning. This works only as long as participants are content with paper settlement. The moment confidence shifts and holders of contracts begin to question whether those claims can be honored with real metal, the disconnect becomes impossible to ignore. You cannot print silver. You cannot create it with accounting entries. It must be mined, refined, and delivered. When demand converges on the physical side, paper markets lose their ability to dictate reality. What makes this disconnect so dangerous is that prices are set almost entirely in the paper arena. Futures, markets, derivatives, and algorithmic trading determine the quoted price of silver worldwide. Even though these mechanisms represent claims on silver rather than silver itself, when physical demand rises, it should push prices higher to rayation limited supply. Instead, paper selling can overwhelm that signal, pushing prices down even as real-world availability tightens. That inversion is not sustainable. The illusion of liquidity is another critical part of the problem. On paper, there appears to be endless silver available for trading. In reality, the pool of metal that can actually be delivered at short notice is remarkably small. Most silver is tied up in industrial use, long-term investment, or inaccessible forms. The freely available float is thin, and when multiple parties reach for it at the same time, stress emerges immediately. This is where the system reveals its fragility. When physical demand spikes, the response is not a smooth adjustment in price, but a scramble to manage expectations. Delays, premiums, and restrictions begin to appear. These are the early signs that the paper price no longer reflects the true cost of obtaining silver. The more this happens, the less credible the paper market becomes as a pricing mechanism. The disconnect also encourages behavior that deepens the problem. Suppressed prices discourage mining investment, which limits future supply. At the same time, artificially low prices stimulate demand, particularly from industries and investors who see value in acquiring physical metal at a discount. This dynamic steadily drains available inventories while paper claims continue to grow. It is a slow-motion collision between perception and reality. There is a broader lesson here about financialization. When real assets are turned into abstract trading vehicles, the link between price and substance weakens. This has happened not just with silver, but with currencies, bonds, and even equities. The difference is that silver has a hard physical limit. You can't expand supply to meet financial demand simply by lowering interest rates or increasing leverage. Eventually, the math stops working. As more participants recognize this disconnect, behavior shifts. Investors begin to prioritize possession over exposure. Industrial users seek long-term supply agreements rather than relying on spot markets. These adjustments further strain a system designed around the assumption that physical delivery would remain the exception, not the rule. The risk for the paper market is not just volatility. It is irrelevance. If the quoted price consistently fails to reflect the cost of acquiring physical silver, market participants will look elsewhere for pricing signals, premiums, private contracts, and alternative exchanges begin to matter more than futures quotes. That erosion of confidence is difficult to reverse once it takes hold. Ultimately, the physical versus paper disconnect is a reminder that markets cannot defy reality forever. Financial engineering can mask scarcity, but it cannot eliminate it. When the gap between claims and substance grows too wide, the adjustment is not general. It is abrupt, disruptive, and often shocking to those who believe the paper price told the whole story. Silver is approaching that reckoning, not because of speculation or hype, but because physical reality is reasserting itself in a system built to ignore it. What's unfolding in the silver market is not an isolated anomaly confined to one commodity or one exchange. It is a reflection of much deeper forces at work across the entire financial system. When stress appears in a market that has long been considered manageable, liquid, and well understood, it raises serious questions about the stability of everything connected to it. Silver may be small compared to equities, bonds, or currencies, but its behavior under pressure offers a glimpse into how distorted modern markets have become. At the core of these broader implications is the issue of confidence. Financial markets today are built less on tangible value and more on belief. Belief that counterparties will perform, that liquidity will always be available, and that central institutions can step in whenever something goes wrong. This confidence has allowed leverage to expand, risk to be mispriced, and imbalances to persist far longer than they otherwise could. When a market shows signs of stress, it challenges that belief system. A freeze, a delay, or any disruption in normal trading is a reminder that markets are not self-sustaining. They depend on trust, and trust, once shaken, tends to spread. Participants begin to question not just one market, but the assumptions underlying many others. If physical delivery becomes an issue in silver, investors naturally ask where else paper claims might exceed real assets. That question doesn't stop at commodities. It extends to bonds, currencies, and even bank deposits. This is particularly relevant in a world saturated with debt. Governments, corporations, and consumers have all relied on cheap money and the assumption that refinancing will always be possible. These debts are serviced not by growing productivity, but by continued access to liquidity when markets function smoothly. This looks sustainable. When stress emerges, the fragility becomes apparent. If confidence in one area erodes, funding costs rise elsewhere, and the system begins to feel the strain. The implications for currencies are especially significant. Precious metals have historically served as a check on monetary access. When demand for physical assets increases, it often reflects declining confidence in paper, money. If silver, a metal deeply tied to industry as well as investment, begins to exhibit signs of stress, it suggests that concerns are not limited to speculative hedging. They are rooted in real economic uncertainty. This uncertainty is amplified by the role of central banks. For years, they have acted as backstops, suppressing volatility and encouraging risk-taking. While this has supported asset prices, it has also distorted market signals. Prices no longer reflect true risk or scarcity when an unmanageable situation finally emerges. Policymakers are left reacting rather than controlling. Their interventions may calm markets temporarily, but they also reinforce the perception that systems are unstable without constant support. Another broader implication lies in how investors allocate capital. Prolonged distortions push capital into areas perceived as safe, often regardless of valuation. When those safe haven't show cracks, the search for security intensifies. This can lead to abrupt shifts draining liquidity from some markets while overwhelming others. Such movements are rarely orderly. They create volatility and expose weaknesses that were previously hidden by complacency. There is also a geopolitical dimension. Commodities are global markets, and stress in one region can ripple across borders. Supply chains, trade agreements, and strategic reserves all come into play. When access to essential materials becomes uncertain, nations reassess priorities. This can lead to hoarding, export restrictions, and policy responses that further tighten markets. What begins as a financial issue can quickly evolve into an economic or political one. Perhaps the most important implication is psychological. Markets are forward-looking, and perception often moves faster than reality. Once participants sense that a system is vulnerable, behavior changes, risk tolerance declines, hedging increases, leverage is reduced. These shifts can slow economic activity even before any actual shortage or crisis materializes. In that sense, stress becomes self-reinforcing. The silver market, the signal should not be ignored. It is a warning that years of financialization, leverage, and reliance on confidence have created a system with little margin for error. When stress appears, it reveals how interconnected and fragile modern markets truly are. The lesson is not that collapse is imminent, but that stability is far more conditional than many believe. In the end, broader market implications are about recognizing limits. Markets can be managed, influenced, and guided, but they cannot be divorced from reality indefinitely. When pressure builds, it seeks release somewhere. Silver may be the messenger, but the message applies everywhere. Systems built on assumption rather than substance eventually demand adjustment. And when that adjustment comes, it rarely arrives quietly. So ask yourself, this Comex can halt selling in silver, a market historically dwarfed by gold in valuation. What does it mean for the rest of the financial system under stress when markets stop functioning as they should? Confidence is at stake, and confidence in currencies, in markets, in economic narratives is the only thing standing between today's headlines and tomorrow's crisis. Stay alert, stay informed, and remember, when markets signal stress with this level of clarity, it's not the time to turn away. It's the time to pay attention.